So the Indian real estate sector is going through a fair amount of maturity, I would say. This sector used to contribute 5-6% of the GDP. We think is by 2030, it'll contribute about 20%. So nearly $1 trillion. Because we're saying is that we're going to be $5 trillion economy by 2030. Nearly $1 trillion is going to come in from the real estate sector. So, the guys who are in this room are going to benefit if you listen to these stalwarts who are with me. Clearly the sector has to move towards more efficiency. And we are seeing that, from maturity, it is now going to move into efficiency. I mean, look at offices, which was really beaten up. Even in the offices which was beaten up, the leasing demand, we believe, will be between 30 to 34 million square feet within this calendar year. I mean, I sat on a board meeting this morning, and we had these results come through. It is just phenomenal to see the leasing demand that is coming in on the offices, and particularly Mumbai, which has now got 50% of all its office parks where people are coming in and attending those, in comparison to Pune or Bangalore, which is still languishing at about 18 to 20%. But really, Bombay has come back with full vengeance, and you can see this hall getting filled up. Also, the pre-leased commitments that we are seeing across the board on the offices, which I didn't expect that it would bounce back so quickly. I mean, Resi, we've been discussing it, that is bounced back, but offices, I didn't expect that it was going to come back so quickly. Even the malls, I mean, most of the mall developers you speak with, they're saying is that we're going to be upping the rent by 15 to 20%. The March 2022 sales of the retailers was 1.2x of March 2019. I'm not even comparing with March 2020 because March 2020 was truncated. So March 2022 is 1.2x of where we were on the sales side. And clearly, you look at Phoenix, 5 new malls, you look at Reliance Retail, they're saying is that they're going to grow 3x over the next 3 to 5 years. The biggest portion is residential, which is what we're going to discuss largely today. That's nearly 80% of the India's real estate. And on the resi side, the sales that have happened, I mean, phenomenal. If you look at the listed guys, Prestige said 10,500, Lodha said 14,000 crores that they have increased. I mean, Runwal, both Sandeep and Subodh put together 6,300 crores. They have crossed, planning to get up to 7,500 crores. Oberoi's, Kalpatru, everybody who's gone, phenomenally well. And what is very exciting is that our research is showing is that 2023 financial year will be as vibrant as what we had seen in 2012. Many of you may or may not be here, but 2012 was one of the best years on residential. 2023 on Resi, we're saying is we're going to be back off the 2012 levels. 2012 was a lot led by NCR. 2023 financial year is going to be a lot led by West India, because 50% of the total sales, we believe, is going to come in from this region. And then, new things that have started to come in, the millennials that are starting to really, buy. Private equity, we are surprised on the domestic private equity. The way that they are putting in money, nearly 2x of what it was last year has come in from the domestic private equity into the residential sector. This and a lot more we're going to discuss with our panelists here. I'm going to start with Mr. Mistry, you. One pertinent question, I think it is in the top of every guy in this room, is the merger that has happened between HDFC and the HDFC Bank. I mean, it is mother of all mergers, the announcement that it came in. And what was very, very surprising was nobody knew it. Nobody knew it. The press didn't have any hint of it. And such a big merger to be able to do and keep it so calm was phenomenal. My question, Mr. Mistry, to you is that how will this merger really benefit the economy? How will it benefit the shareholders? And how is it going to benefit the consumers?
Well, I guess if I answer that question, it'll take the full 45 minutes. So I'll try to keep it brief. Yes, we had to keep it quiet naturally because it's not something you would want in the newspapers before it got announced. So there'll be huge benefits to the economy, to the shareholders, in fact to all the stakeholders. Just to give you a sense, you talked of shareholders. The synergies that come out of the merger are going to be so huge, whether it is in terms of cross-selling, whether it is cross-selling mortgages to HDFC bank customers, whether it is selling banking products to HDFC's customers, whether it's the removal of the 40-odd% holding company discount which exists today in the HDFC share, which automatically means that when the merger takes place, we should see hopefully an accretion in the market cap by nearly 60,000 crores, which is 40% of 1,50,000 crores, which is the unrealized gain on our bank shares, which naturally the holding company discount will go. So there are many, many such benefits. So I don't want to get into that discussion now. We can have a separate discussion. But as far as the economy is concerned, it will create a bank with a significantly higher balance sheet, significantly larger balance sheet, and therefore the ability to take part in India's growth structure, growth strategy, the focus that the country needs today on infrastructure and on everything else, on supporting economic growth. So that will help the economy, it will help the stakeholders, it will help the shareholders, and to my mind, it will help even the real estate developers because there'll be a significantly larger balance sheet, and the bank is committed to provide funding to developers the same way as HDFC was.
I think we're sharing a mic. Sir, given HDFC's positioning, you're very uniquely placed to evaluate the residential real estate sector. Two questions that I wanted to ask is, in your opinion, in this current situation, what are the key drivers for the housing sector? And what do you think can become a party spoiler?
So I think the housing sector, and I've said this in the peak of COVID, if you see some of my interviews in various magazines and media, even in, I think it was in August or September of 2020, from that time itself, I've been extremely bullish, not just on the real estate sector, but on the entire economy. At a time when COVID was really, very much there. So I continue to be extremely bullish, and I think the factors which will drive the demand in the real estate sector are many. So first, let's look at the period from 2017 to 2020. That period of 3 or 4 years clearly saw a slowdown in demand for high-priced real estate, particularly in cities like Mumbai, Delhi, Bangalore, and high-priced locations. And whilst the growth was coming from all the tier 2 and the tier 3 towns, the affordable housing segment, the high-end market was very weak. Now what COVID did was it made it more imperative for most families to look for bigger or larger homes. So that was the first driving factor. And once you started seeing, and this was hugely facilitated by the various governments. I think the government, whether it's the state government or the central government, recognizes the fact that housing is a huge spur for economic growth. Because there are so many industries which are dependent on the housing sector. Whether you're looking at cement, steel, paint, power, and all the ancillary industries which support housing. And also look at the amount of employment that housing generates, both directly and indirectly. Directly in terms of construction workers, masons, carpenters, plumbers, engineers, and so on and so forth. So that is really the need of the economy, and therefore we saw support coming from various states in the form of reduction in the stamp duty rates. You saw October to December, Maharashtra reduced the stamp duty from 5 to 2, and then from January to March 21, from 5 to 3. So we saw a reduction in stamp duty, and we started seeing a pickup in demand. And when you started seeing a pickup in demand, all these belief that, the belief that people had that there was huge amount of oversupply in the market, and because of that oversupply, prices would never go up and would remain depressed, that fear or that notion went away. And when that notion went away, you found a lot more people who were sort of sitting on the sidelines willing to take the plunge. And then people realized that in that 2017 to 20 period, whilst income levels had continued to rise by whatever 8-9% a year, property prices really had not gone up. So when you look at it in terms of affordability improved dramatically, because house prices in 20 were similar to what they were in 17, while income levels were nearly 30% higher at the rate of nearly 8% a year. So that created that spurt, that demand which sort of picked up. And there are so many basic fundamental factors. I think the biggest factor is the fact that we have a young population in India. 2/3 of our population is below 35 years of age, and the average age of a first-time home buyer, as we all know here, is around 38, 39 years. So there are so many young people today who are not looking at buying a house, but potentially over the next 1, 3, 5, 7, 10, 15 years, all these younger people will need a house. So I see a very, very bright future for the real estate sector.
And sir, what can become the party pooper?
I mean, at this moment, frankly, I don't see anything on, I mean, little bit of higher interest rates or a little bit higher property prices, to my mind, is not going to make a material dent in terms of demand. I honestly believe so. Interest rates have never been as low as they have ever, as they are at this point of time. Never in history. Never in history, over 40 years of working, I've seen interest rates on housing loans at sub 7%.
Wow.
So even if rates go up 25, 50, 75 basis points theoretically, purely theoretically, it's not going to dent the demand. But the feel-good factor, the most important thing which is spurring demand today is the feel-good factor. And the feel-good factor is happening, and if you talk to people in labor-intensive industries, one of the things they will tell you consistently is that the one thing that they are seeing all the time is wage inflation. Wage inflation means people are getting better jobs, people are getting higher salaries. And to retain those people, the companies themselves have to pay higher salaries. So higher incomes obviously creates that feel-good factor, and therefore that willingness on the part of the consumer to take that less. So as long as that feel-good factor is there, I don't see anything impacting the business.
Got it. Sir, one of the things that you discussing with the developers here, you will find is that many of them are finding challenge with the input costs, the way that these input costs are increasing. Do you think that the consumer is going to be willing to accept the increase in the input cost by increasing the sale price, or some part of it may have to be absorbed by the developers?
I would say it's a mix of both. As I said, from 2017 to 2020, property prices did not rise. Income levels rose 8%, 7.5%, 8.5% a year. So income levels are much higher. So even to get back to the kind of affordability which was there in 2019, if there is a slight rise in property prices, I don't see any significant pushback from a home buyer. But if you're looking at cities like Mumbai and Delhi, land is such a large constituent of the cost of a project. And in land, prices have, I don't know how much prices have gone up, but the input cost, the steel and cement and stuff like that, that is not such a large component of the total cost of a project. So I think it will have to be a mix of both. Some part the developers will have to bear, and some part will have to be passed on to the consumer.
So one of the things that many developers face today is the challenge on funding. The good developers get more and more and more, and the more aspiring developers are sort of struggling to get funding. Do you think that this dynamic is going to change, or it'll get more skewed in favor of the good quality developers?
Difficult question to answer, but I think clearly in a banking structure, the way the regulations are framed, and Anup can answer that question better, but the way in a banking structure, the banking format, the regulations are such that clearly the real estate developers get favored. But at the end of the day, the smaller developers, the relatively smaller developers, they are the ones who are constructing the kind of properties where there will be retail demand. And as long as there is retail demand, there will be the likes of HDFC or ICICI or TATA or whoever who will be willing to fund them. So money will be available. Obviously, there'll be some differentiation in the rate which AAA developer gets versus a less regarded developer, but so be it.
Yeah. My last question, sir, is which of the asset classes you're quite okay to fund? Retail, commercial, residential, industrial? Or maybe what's the priority?
I mean, our priority at HDFC at least has always been resi.
Residential.
Always been resi. But we are happy to look at all the other segments.
Including retail?
Including retail, but selectively, obviously. I mean, you'll have to look at it project-wise, but our focus really is residential.
Residential.
So if you look at it on a balance sheet basis today, 79% of our loans are to individuals And if you look at it incrementally in the current year or in the last quarter, for example, about 78% is individuals, 22% is non.
Great. Anup, I'm going to come to you. Couple of quick questions before we get into the question. What Mr. Mistry said is that you may be able to add some color. You know, one of the sessions that we had earlier this morning was really on the IPO side. What's your thought as many developers prepare themselves to hit the browsers? What's the thought? Is this going to continue, or you think is that this was something which was a little bit more seasonal during the time of COVID, and we're going to see this getting stumbled?
No, good question. Because from an IPO perspective, it depends on what kind of investors come. So I would say that on balance, if one gets private equity, this is a better private business than a public business. And the reason is that in public business, the kind of investors, there's nothing good or bad about it. The kind of investors which come in the public market, they require more predictability than the public or private markets. And to that extent, unless you get to a size where you're diversified enough that you can give some kind of predictability, post-IPO, it can be very, very volatile. The good thing that happens in IPO is that in general, the governance standards tends to improve, because in a private business or in a family-owned business, sometimes you don't have good access to good quality feedback, because from internal you don't get that kind of feedback. External, there is nobody to give you feedback. Now what happens in a public market is that whether you like it or not, somebody will tweet if your results are bad. So you can be blind, but you have to also close your ears. And if you are blind and you close your ears, then nothing will happen, your wealth will get destroyed. So the good thing about public market is that in general, the feedback loop is very good. And for the good, they take the feedback loop positively, and there is an auto correction in the way you run businesses. So initially it is a bit discomforting that I have to now disclose, I have to do all these things. But over a period of time, large companies must go public. Also from other things like succession planning, etc., it is a much, much better route. If you're a public limited, if you're a listed company, than if you're completely private, because breaking, carving out, etc., is a big, big, big issue. So I would say on balance, IPO markets, if you're big, if you're reasonably diversified and hence sustainable, is always a preferred route. Initially, I would say that holding it private till you go to a size is good. So that's really the stage.
No, absolutely, I agree with that completely. Anup, the overall improvement in financial discipline of developers has been very evident. We've seen in the last 3-4 years post the IL&FS crisis, there has been a fair amount of financial prudence, governance, discipline within the developers. Has this changed the funding scenario?
No, it certainly has changed the funding scenario. See, initially I have seen, many industries. One of the industries, let's say stockbroking as an industry. I mean, you look at stockbroking 30 years back to look at stockbroking now. You look at now real estate, which is improving phenomenally and morphing in a way. What happens when initial regulations come? You're not prepared. The sector is not prepared for regulation. So it's very, very discomforting. The whole body gets sore and it's painful because many of the muscles have not worked at all for many, many years. And so regulations pushes that, and regulation shifts, because there is no voice of a small customer. So regulators always look at the voice of the small customers. And that is where the balance of power starts to shift. But it is very, very good because it makes it sustainable. It gives assurance benefits to the public at large. And once trust and assurance benefits comes to the public at large, it is easier to trust. How do you trust an unknown person if you don't have a very strong assurance function? Then you can only do business with friends and families. It is never, never scalable. So regulations, listing, these all increase the assurance functions, and to an unknown person you can trust. So today, if you have RERA, if you have other regulations which are coming in, if you are listed, let's say RERA, etc., it gives you a better method of trust function. The other thing that it does is also over a period of time reduces the delta between an unknown person to a known person. Because if the regulations come up, for example, in a flight, when you take an aircraft, I mean, you don't distinguish between one and the two, and you don't look at the P&L before you board a flight. Why? Because the safety levels have been taken to such a thing that no flight is going to crash. So you look at rates, but you don't look at the P&L of the. So that is what regulations does. So it's brilliant. Regulations are good, initially discomforting, but for the good guys. See, these are all for good guys. See, for bad guys who want to live in shadows, I mean, good luck to them. For the good guys, for economy, I think it's brilliant. These things are.
And this is the question I want to continue, and I'd ask Mr. Mistry as well. The same thing is that the good quality developers, Anup, are getting the money. They're absolutely fine, and they're also getting at very competitive rates. The trouble is, I'm not saying not good quality, the aspiring developers. They're sort of struggling to get in the funding at this moment in time. Is there a way that we can bring in sort of more money to those guys?
No, the capital structure has to be corrected. Because the capital structure cannot be tilted too much towards debt.
Oh, yeah.
Because see, debt is an adverse ratio business. You make 3-4%, but you can lose 30-40%. These are not good to take bets on future cash flows. Future cash flow betting is essentially an equity model. So you must get equity and share equity and share upside for initial. Once you become big, that is when your debt comes in. In adverse ratio business, to expect that a debt guy who is making 4% and can lose 40%, to take bets like equity on future cash flows is not a very reasonable expectation. It's not a reasonable expectation. So mesh finance, sharing of upside, and that's how you become big. And once you become big, then of course, all the goodness will flow.
The trouble is, Anup, where do you get equity from? I agree with you that equity needs it, but equity is just not available in real estate. Certainly on the residential side, there is very little equity available.
On the residential side, the reason why it is, on the commercial space, if you see,
yes,
there is not a single developer, almost, not a single developer who has put all the equity. Residential side, what my observation is that because it is smallish, people think you can get away with it. You don't require to dilute the upside. But there are ways to dilute upside. I think the one key mental model that we have to break is sharing of upside. And in the past, whenever there has been an investment by private equity, where it is not a structured debt, but it's a equity upside, the experience has not been great of both sides. I think the partner experience has not been very great.
Yeah. Well, I certainly think one side hasn't been great. I'm not sure about the other side, but certainly from the private equity side, it hasn't been a very good experience. So you're absolutely right on that is. During the COVID, commercial and retail assets did have some challenge. And, many of the occupiers in those did not pay the rentals. And, we saw the collections really dipped and, they sort of impacted. Is there a thought, Anup, that you within your institution have that we want to change the way we look at LRDs?
No.
As aggressive, no rethinking on the product.
No rethinking on the product, but LRD, LRDs also come in different shapes and sizes. So tenancy is important and occupancy is important and all those risk factors are important, but LRD as a product is a good product because the other thing that LRD does is clearing your capital structure and recycling your equity, I think, which is very, very good. So, I mean, you reduce the LTV and you do LRD. I think it's a great product to have. It recycles capital and you can grow, because one of the things with all entrepreneurs is that they need to grow. I mean, if you don't grow, then why are you an entrepreneur? Might as well put it in a fixed deposit and move on in life. So you have to have equity coming back, but equity can come back if you create value and then you recycle the equity part of it. So that is how one has to think. But now it is changing. I must also add that it is changing and people have realized that equity is a constraint. You cannot hold on to equity, and which is why in commercial it is completely broken.
Yes.
It's completely broken, and in large residential it will get completely broken. And also REIT and other structures will start to come in. It hasn't come in a big way, but I can tell you in 10 years, we will sit in the same room and we'll see that the number of REITs that will be sitting across this room will be multiple times higher. Because we need to recycle capital. And to recycle capital, you require very strong assurance functions and guardrails, so that a stranger can trust you. See, the important thing I'm just trying to repeat again. How does a stranger trust you as against friends and family? That's really the breakthrough of any industry.
Yeah. And this is a very important point that because you've stressed on twice or thrice now, that is where it is, and that's where I think the differentiation is also happening, Anup.
It is already happening. You can see the K happening. The better developers are becoming better. The worst developers are
Perishing.
Perishing.
And my last question is that are there any lending norms that have changed between pre-COVID and post-COVID?
No, it depends on case to case. Actually, on the residential side, like Keki said, I mean, it's very good because, I mean, there is no lending norm change. On the other side, which is non-home loan, I mean, it's a function of the risk that you take. So you adjust your LTV, you have more sort of, if you have higher confidence on cash flow basis, tenancy, etc., it is better. But no, by and large, no, one becomes careful at times, but one comes back. I mean, we are also a commercial entity. I mean, on a risk calibrated, I mean, we also have our things to do. I mean, you can't get out. But I must again remind everybody that lending is an adverse ratio business. You make 3%, you lose 40%. And I mean, it's not, I mean, who will do such a business in this room where you can lose, you can make 3% and lose 40%. People want to make 40% and lose 4%. You do 2:1, 3:1 risk reward ratio. You don't do an inverse ratio of 1:10. So we have to be careful. We have to be careful. Equity guys who take the upside, they can do whatever they feel like.
And my last question, Anup, sorry, is that other than public markets, private equity, and the debt that comes in from, HDFC, ICICI, and the other NBFCs, is there any other way that the funding you think in future is going to come in? One of the things you said is REITs.
No, I think REITs is a very, very good way by which funding should come in, and
But on residential, how would that work with the yields that we have? Very tough for resi REITs.
No, it is tough.
It'll come in.
But it will come in. I mean, it will come in. I think rental yields in India has to move up. I think because of, we are an anomaly actually. I mean, REIT is a completely okay product. I think our cost of land, etc., which Keki was saying, is such a large proportion of the total cost that you look at rental yield. I mean, it doesn't make sense to buy a house. Exactly. Unless the only thing deterrence, I think, because every 11th month you can get moved out. That's the only fear that pushes people to buy a house. Otherwise, why will you ever buy a house?
No, I agree with that. And my guess is the only compression that can happen is really on the land pricing.
But for work from home and other things, you never know. You never know. I mean, in Bombay itself, we have seen the center of gravity shifting at many other places. I mean, from South Bombay to Parel and BKC, etc. I think many more centers. I mean, if Bombay had 10 centers, center of gravity will shift. I mean, we should not be, oblivious of that. The center of gravity shifts very quickly. And now with the digital and tech, it can move much more rapidly because you don't have to commute. I mean, that's not an equation that we should take away from this whole game. I mean, it's a very, very big and strong equation.
Rajiv, welcome. It's a pleasure to have you here. And, Tata Capital and Housing did fantastic job. I was reading is that the net profit registered a quarterly growth of 126%. In Q1 2022. But my question is slightly different from real estate is that how's the overall offtake in other verticals? For example, on the personal loans, vehicle loans, business loans, is that also equally strong and going good?
I think there are few sectors in the economy, if you look at, which are, contributing to this growth rate which India has seen. And the consumer business has been one of them. It's been, in fact, leading the growth on all fronts. Whether it is housing. Housing has been a big boost to the retail growth. Along with it, the personal loans. I would say even auto loans and commercial vehicles have picked up of late. The last few months for commercial vehicles have been extremely good. Construction equipment has picked up. So there is more activity which is happening on that front. I would say almost all sectors have shown an uptrend. Even the sectors which were not doing well, hospitality.
Correct.
You look at the results. The Indian hotels results were out yesterday. So phenomenal results. Like the top line growing by 100% over previous year. So I think all sectors, aviation, look at aviation. So there is huge capacity utilization improving. I think the only thing we all need to watch out for and which people are saying is what will happen to margins with these commodity prices and fuel prices, energy prices going up. That's the joker in the pack we will need to watch out for.
And Rajiv, it is the same for real estate as well. And you know, our thought is that much of that may get pushed to the consumer.
Exactly. So it is already happening. If you notice, real estate prices across cities have gone up. So in a way, it has gone up.
Can the entirety be pushed to the consumer, or some of it will need to be borne by the manufacturer?
Margins will compress. There is no doubt about that. Even if you looked at the Unilever results which were out yesterday, it also pointed to the same thing. The increase in prices which they had done, compared to that, whatever gains they saw was lower. Obviously raw material prices had moved up much faster. I think when you talk about real estate, the problem is not so much on what you're selling now. The problem is what you sold a year back.
Yes.
And the industry has still, and I keep talking to the industry, but I think people have still not evolved to a method of saying that we have to find a way of linking our price
Completely
to the raw
agree.
material cost.
Yes.
It's a matter of time, like Anup said for a few other things, it's a matter of time. You will have to move into this. If you remember, home loans, before 2002 were all fixed rate loans. Mr. Mistry will remember, till the whole market shifted. So it's a matter of time when real estate developers will also start finding the right index to which they will link their unit prices.
Yeah. And Rajiv, to me, that is the biggest challenge. I mean, if you were to speak with any evolved developer here, they will say this is the biggest challenge, because you're selling today something that you're going to deliver in 5 years' time. You have no idea whether it's going to be another Russia, Ukraine, another COVID, but your price is fixed today. I mean, it is a very unique business. I don't know how many businesses are like that, where you're fixing a price today, which delivery has to happen 5 years later.
So there were businesses like this, and you know what has happened to them.
Yeah.
Look at some of the power plants who had entered into an agreement on a price without factoring in what would the
Cost
coal prices
escalation.
be. So, we have seen those challenges. So on both fronts, developers will have to move. I think 5 years, nobody now wants to do a project which will take 5 years for delivery. I think everybody is talking about 2.5 years, or stretching it to 3 years. But within that period of time, you have to deliver. But even that period is long enough for commodity prices to, the way they have...
To disturb.
Disrupt. So there is no other option but to move in that direction.
I'm told I have to wind it in another 7-8 minutes. Before I come to you, Rajiv, on one more question on NBFC, Mr. Mistry, I do want to ask you is a little bit more macro in terms of the Indian economy. You think is that it'll continue to grow the way that we are growing, or there are challenges other than inflation which can disturb this?
No, I think I think I mentioned it also. I'm extremely bullish on the Indian economy. I believe the growth potential continues to be huge. The one thing we have to ensure is that we continue to create jobs, because we have so many people, I don't remember the exact number, who pass out of business schools every single year, and we have to create jobs for them. As long as the economy is vibrant, and I think the government fully recognizes that, and we must compliment both RBI and the government for the measures that they took during COVID to ensure, RBI on its part ensured that they put in enough liquidity in the system, dropped interest rates. Not only did they put in liquidity, they ensured that every single segment of the market had access to that liquidity. And to the government for the various measures they've taken. And it's because of these efforts that the economy in India today is so strong. Obviously, there will be some challenges. Every economy faces some challenge or the other. And I think on this issue of inflation, there has been so much of discussion on inflation. Look, and people are comparing India with US. I think we must understand that India and US are two different countries. Historically, US had extremely low inflation, and India had much higher inflation. So US is just not used to a situation where inflation is high. And therefore, the measures that they need to take have to be a lot more dramatic, a lot more stronger than what we need to do in India.
Good point. Very good point. Rajiv, just coming back to you on this RBI, they seem to have sort of tightened the norms for NBFCs, and they're saying is that we're going to tighten it more for the sensitive sector, including the real estate. Are we going to witness consolidation in the NBFC space?
See, first of all, I think as a view, I think all these norms are very good. They will help build businesses which will last lifetimes. So from that perspective, I think it is very good. In fact, at times now NBFCs are thinking, how do they bridge the arbitrage which banks have over NBFCs? It's now the table has turned the other way. Right. So one needs to look at how do you bring in, similarity on that front. Your other question was.
That, with these tightening of this thing, consolidation will take place in NBFC?
In a way, it is already happening. But, as Anup mentioned, lending is a very different business, and retail lending is even more difficult business. Because, when you do wholesale lending and I want to assess another company which I want to acquire, it's much easier. I need to look at the list of maybe 30 names or 40 names and decide whether I want to do it or not. But in retail, it is very difficult. So personally, I feel very uncomfortable if I buy something which I have not originated. So my confidence is far more on what we have originated. Because, in this business, what we have seen, as if you get your credit right, if you grow, profits will just multiply. You have to just get your risk metrics right. That's the only thing. And if there is a way you can build that trust on the risk metrics of another lender, I think consolidation will happen. Else, there'll be a set of companies who will die.
My last question, Rajiv, we have a number of developer friends here. Can you tell top 3-4 criteria that you look at when they come for funding to you?
I think
everybody's your friend here.
Same. I think everybody will talk the same language here because the view has been very similar. You look at the developer per se, the person who's backing the project. You look at the location of the project. You look at the product which you are making, how saleable will that product be. And you look at what equity has been brought in by the developer in the project.
I think that's a bit of a challenge which Anup has also said again and again, and that's a big learning is that this equity, most of the games that we were playing was purely on debt.
Anuj, I just wanted to mention one point, what Anup mentioned. But yesterday I was talking to someone and this person said that, look, we raised money and it was a small quantum. They raised 100, but they say that they've got commitment of about 500 crores. And he said, the way we did it was we said we will extend money to developers who are not present in the top 25 locations. And he says, we've been doing it for 1 year. We've just remained under the radar and there has been no problem with that. So, you were asking whether the people in the deeper towns will get money or not. It is all a game of supply and demand. Right. You look at telecom, initially everybody wanted to be in Mumbai, Delhi and those big circles. Later on, UP East was also a big circle. So everything became a big circle. So it's all a function of supply and demand. If there are more players, you will find all avenues being targeted.
Wow. I could have gone on and on and on. I had a lot of questions to still ask. I know that we're being asked that we need to end this, but fantastic. If you look at it, after a very, very long time, you're really chairing sessions where there is so much of positivity. Whether it is the economy, whether it is the real estate sector, whether what we heard today is that regulations are very, very good, very important for the growth and maturity of the sector, whether it is that the good are going to become that much more better, they're going to become more stronger, and everybody is really going to back those good developers. So, going back home, one will have to think is, how do I become that good developer, whether it is the financial discipline, whether it is the corporate governance, whether it is on the delivery that we continue to focus, because that's the way that this industry is really going to go. I do feel is that, on the inflation side, there is a little bit of a challenge. We will see is that how much of that is going to be absorbed by the end consumer on various sectors, not only real estate, and how much of it will be shrinkage of the margin. And if that is what is going to happen, Rajiv, shrinkage of the margin, then I think we will have to think is, how do we make our organizations even more efficient? Otherwise, we will go in the risk where there is going to be issues if we do not bring in that efficiency and modernization. With that, I thank Mr. Mistry. What a delight to see you. Anup, thanks for coming in. And Rajiv, thanks for sharing your views. Thank you.